Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data. Because while US retail investors are asleep and the public price sits at 139, something is being constructed on the institutional side of this market that the public chart cannot show you. In the last 6 days, 285.2 million XRP has been removed from centralized exchange order books, and in just the last few hours, a single batch of 24.6 million XRP moved from centralized exchanges into a Tier 1 US institutional custodial bridge in one transaction. Major US over-the-counter desks are now quoting XRP at a 15% premium above the public exchange price, meaning the institutions with access to OTC markets are willingly paying 160 for an asset that retail can still buy at 139. Stay with this analysis until the end, because institutional desks in New York have calculated a structural liquidity floor of exactly 5,085, and the digital commodity certification being fast-tracked for a presidential executive order is the mechanism that makes that floor not a prediction but a mathematical inevitability. Let us begin with what the 15% OTC premium actually communicates, because this single data point dismantles the narrative that institutional interest in XRP has stalled. An OTC premium exists when institutional buyers are willing to pay above the publicly quoted exchange price to secure volume without appearing in exchange order books. The reason institutions pay that premium is precise and mechanical. They cannot source the volume they require from the visible exchange order book without causing the price to move against their own purchase. The 285.2 million tokens removed from exchange supply over 6 days have compressed the available float to the point where any large institutional purchase attempt on a public exchange would immediately trigger the kind of upward price movement that makes further accumulation at target prices impossible. The OTC desk is the institutional solution to that supply problem, and a 15% premium is not a casual overpayment. It is the measured cost of securing XRP supply in a market where the visible float has been systematically depleted by 6 days of continuous institutional accumulation. The retail investor staring at the 1.39 price tag is making a perceptual error that every institutional accumulation cycle produces in the retail participant base. The error is treating the public exchange price as the relevant price signal. The public exchange price reflects the transactions that retail participants are conducting in the visible order book. It does not reflect the OTC transactions where institutions are paying 15% above that price for the same asset. It does not reflect the custody transfers that have removed 285.2 million tokens from the available supply without creating any price pressure. And it does not reflect the institutional research notes circulating in New York right now that have calculated $5.85 as the structural liquidity floor for the use case that the presidential executive order is about to formalize. The retail holder, who interprets the $1.39 price as evidence that nothing is happening, is reading the headline of a story whose most important information is in the institutional data that runs beneath the visible market. The 585 structural floor calculation requires the same analytical precision that the earlier 445 and 482 calculations demanded, because each successive floor figure reflects a specific and verifiable change in the institutional demand framework that produces it. The current 585 figure emerges from institutional desks in New York recalculating XRP's fair value following the leak of the digital commodity certification language. The specific calculation models XRP's function as a legally protected digital commodity bridge for U.S. trade, the settlement layer that moves value between U.S. financial institutions across the regulatory framework that the digital commodity certification establishes. At the transaction volume that U.S. banks are projecting for digital commodity bridge operations, the minimum XRP price required to provide sufficient liquidity depth for settlements above $100 million daily without generating slippage that destroys the cost advantage is 585. This is a liquidity depth calculation. The number is determined by transaction volume, settlement frequency, and circulating supply, not by market sentiment. The Ripple Treasury collateralization mechanism has now reached a weekly interest surplus of $5.8 million, a figure that continues to expand as RLUSD issuance scales with the institutional banking relationships that the digital commodity certification is designed to formalize. The $5.8 million weekly surplus is being deployed as an institutional liquidity backstop, a standing capital reserve that ensures U.S. banking partners can access XRP and RLUSD liquidity for settlements above $100 million daily without facing the thin order book conditions that currently exist on public exchanges. The backstop functions as a structural guarantee for the banks that are building their settlement infrastructure on XRPL rails, assurance that the liquidity required for their operational volume will be available regardless of the retail trading environment. When a U.S. bank is evaluating whether to route $100 million in daily settlement volume through XRPL infrastructure, the existence of a funded liquidity backstop removes the operational risk that would otherwise prevent that commitment. The presidential executive order angle represents the regulatory acceleration that changes the timeline framework for everything that has been building over the preceding weeks. Reports from Washington, D.C. suggest that the digital commodity certification for XRP has been fast-tracked for executive order status, a mechanism that would establish XRP's commodity classification at the executive branch level without waiting for the congressional timeline that the Clarity Act requires. An executive order establishing digital commodity certification creates immediate regulatory clarity for U.S. financial institutions that have been operating under NDA while waiting for the legal certainty to convert their due diligence into public operational commitments. The gap between an executive order announcement and the institutional deployment decisions it enables is measured in days, not months. The institutions that are paying a 15% OTC premium tonight are not speculating on whether the executive order will come. They are accumulating before the public announcement makes the current price structurally impossible to sustain. The Ripple executive team's confirmed presence in Manhattan, meeting with high-level Wall Street lobbyists in preparation for Q3 2026 derivative products, provides the strategic context that connects the supply compression, the OTC premium, and the executive order acceleration into a single coordinated institutional deployment sequence. Derivative products built on XRP require the underlying asset to have established regulatory classification. The digital commodity certification provides that classification. They require institutional-grade liquidity depth. The liquidity backstop funded by the $5.8 million weekly surplus provides that depth. And they require a supply structure that can support sustained institutional transaction volume. The 285.2 million token supply vacuum combined with Evernorth's 473 million XRP in a NASDAQ-listed corporate treasury structure provides that supply constraint. The Q3 2026 derivative products are not a future development. They are the next sequential deployment in a program whose preceding steps are all currently executing simultaneously. The ETF data from today's closing session adds the regulated capital flow confirmation that the OTC accumulation and custody transfer activity requires to constitute a complete institutional demand picture. Preliminary data from New York trading desks shows spot XRP ETFs recorded approximately 22.8 million in net inflows during the final power hour of the U.S. trading session. The power hour inflow pattern, concentrated institutional buying in the final trading hour before session close, is a documented institutional execution strategy used by fund managers to minimize market impact while maximizing position building before overnight price gaps. The $22.8 million power hour inflow, combined with the 15% OTC premium and the 24.6 million token custody transfer, represents three simultaneous institutional demand channels operating in the same market window. Exchange supply is now so critically thin that analysts are warning that a single $50 million buy order could trigger an instant air gap price squeeze when the Asian session opens. David Schwartz's confirmation of native on-chain lending architecture provides the technical infrastructure layer that makes the Q3 2026 derivative products operationally viable for institutions that cannot hold XRP as a balance sheet asset under current regulatory frameworks. The native on-chain lending system features automated credit lines, a mechanism that allows major financial institutions to borrow XRP for split-second settlement transactions without requiring them to hold the asset on their balance sheets between settlements. For a U.S. bank operating under Federal Reserve capital adequacy requirements, the ability to access XRP for settlement without balance sheet exposure is the difference between a compliant operational use case and a regulatory violation. Schwartz's confirmation that this architecture is live removes the final operational objection that balance sheet-constrained U.S. financial institutions have maintained against direct XRPL settlement adoption. The infrastructure now supports institutional participation at every level of the regulatory constraint spectrum. The rumored Big 3 bank beta test of a private XRPL sidechain for internal USD settlements using RLUSD and XRP, with JP Morgan and Goldman Sachs identified as the most probable participants, represents the institutional adoption milestone that the entire deployment sequence has been building toward. A private XRPL sidechain operated by a U.S. systemically important bank is not a pilot program or a research exercise. It is production infrastructure being tested before public deployment. The specific use case, internal USD settlements using RLUSD and XRP, is the exact application that the $5.85 structural floor calculation models that the native on-chain lending architecture supports and that the digital commodity certification legally enables. When that beta test converts to production deployment, the demand for XRP as the settlement bridge asset in a Big Three bank's internal settlement infrastructure is not discretionary. It is operational, and operational institutional demand does not fluctuate with retail sentiment. It scales with transaction volume. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.